Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Neuhaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Convexity episode 10 is recorded on the 27th of February, 2024. I'm your host, Henrik Neuhaus. Joining me is my co-host, Jim Wang. I'm glad to return with the 10th installment of our podcast series. Jim, at the end of last year, you laid out your forecast, or your outlook rather, for this year. Now, a few months have passed, and I thought it would be helpful to review what you said then, what your outlook was, and if there have been any updates. Jim, what do you think?
Hello, everyone. I'm glad to return to the new episode. And yes, I think that would be a great idea. To start, maybe you can refresh the memories for our audience and what was our outlook at the time, and then we can start from there.
Sure. Well, some of the sort of concluding points from last time were, so in the very near term, you had expected risk markets to be supported into this first quarter. While you believed that interest rates had peaked, you expected interest rates to rebound into Q1 as a counter-trend movement. However, in the intermediary term, you thought that we're inching towards the end of the current market cycle, and based on our indicators, a recession could be imminent. You also argued that if events unravel as we are expecting them to do, were and still are expecting them to do, we have probably already reached the terminal rate of the current hiking cycle. In this environment, you believe that US rates and Treasury securities presented the best risk-reward trade-off. You also said that there is an elevated risk for equity to experience a significant drawdown this year, and that you expect the correlation between stocks and bonds to return to negative again. Typically, the US dollar rallies once the Fed pauses rate hikes. However, you do think that the US dollar is poised to rally during a risk-off environment. Finally, gold also typically rallies once the Fed stops hiking interest rates, but gold may suffer if there is a liquidity squeeze in the financial markets. Given your recession outlook, you thought that there is more of a downside than of an upside for industrial commodities, but the geopolitical situation, which is tricky, can have a short-term impact on both gold and oil prices and other commodities. Here we are. February is almost over. Yes. Risk assets have been supported so far. Yes, interest rates are rebounding, and no, the recession is not yet here, at least not a broad-based one. Where do we go from here? Please give us an update on your views. Jim?
Yeah, thank you. Thank you, Henrik. So, yeah, I would be very happy to update the views. But before we start, I want to emphasize that, we focus on the kind of the drivers for each of the scenarios that we are describing. And our views will always change if the underlying drivers change. And to develop the forward-looking views, we have to think about how those drivers can change and how they can manifest, in the economy and also in the financial market. As you can see, some of our views were right, some of them were wrong, and it will always remain this way. And how you take advantage of the views and translate it into the trade and the portfolio construction is another complete different, question. So here, and people always say that history does not repeat itself, but it always rhymes. And for us, we always want to understand the cause and effect. So what is the cause and what is the result of that drivers? So in this case, we talk about, we always examine the three-way reaction functions between capital market, the real economy, policymakers, right? And we examine that through the lens of market cycle in the context of market structure, liquidity, right? And increasingly geopolitical, plays a view in our framework. And what do we mean by, cause and effect? We meant that market cycle is typically driven by the monetary policy and the fiscal policy, right? And obviously, long-term economic prosperity is driven by the productivity growth. But from cyclical perspective, as you can see here, the monetary policy is really driving the market cycle, and obviously fiscal policy have become an increasingly important part of this mosaic. So in this chart, we shows the Fed fund rate, which is a red line, and then the pink line is our market cycle indicators. As you can see, once as Fed hiking interest rate and the market cycle indicator, we're marching towards the up kind of up area, right? And start to peter out. And once Fed pause interest rate and cut interest rate, actually, the market cycle peak and start to turn down. And if we look at this, and this is actually follow a normal cycle, right? The Fed hike interest rate curve, and typically, equity will drop, driven more by adjustment of the PE multiple of the risk premium, as we have discussed before, not by the forward-looking earnings, as a matter of fact. And this is happening again this time as well. It was dropping by the adjustment of the risk premium. I would argue still very high, but it was not driven by the earnings expectation. And then once the Fed were able to hike interest rate and the Fed paused interest rate, and also around this time, curves start to, flatten, right, and go to inverted area, right, and once Fed paused interest rate hike, and then start to cut interest rate, and that's typically because of economic, kind of recession, and the curve re-steepen, right, and then stock market have a second leg of decline driven by earnings, right? So that's kind of the cycle that always, kind of repeat. Now, it's easy to see when we look at this graph, but as you can see, the topping, process sometimes can last for a few years, right? And navigating through this is, is not an easy task, but nonetheless, that's what we are trying to do. And so what's different, of this cycle is, I think number one is because of the drastic kind of rise of interest rate, I think the stock market decline, the stock market decline, the magnitude of the stock market decline was actually pretty large in reaction to the rising risk of, rising interest rate and the adjustment of the PE ratio, right? And secondly, I would say, because of the speed and the magnitude of the rising interest rate, and a lot of market participants expect this kind of the peaking, kind of process of the cycle would be sooner and faster. and you can count us as one of them. And obviously, we follow the data. And if you look at this chart, it's basically this is the ISM manufacturing is the green line, right? And the blue line is the leading indicator. Is the difference of leading indicator minus the coincidental indicator, right? So if you look at the history, when you have the ISM and in such a deep for below zero, right, for such a long period of time and with this magnitude, we would have already been in recession. And if you look at the difference between the leading indicators and the coincidental indicators, right, and this is actually comparable in 2008 and 2009. And obviously, there is a lot of other, kind of indicators we're watching, and I would say the vast majority of them, and at a certain point, in nearly all of them, were pointing, with that magnitude, with that kind of time duration. So we're talking about the magnitude of leading indicators and how long and how persist they have stayed in that area. I would say history suggests is the recession is almost a given. And obviously, like we said, history doesn't repeat itself, it rhymes. The question is this a beginning of a new cycle? Or is this an extension of the current market cycle? And if it is an extension, when are we going to roll over to the downside? And how soon that will be? I would say that's the question that we need to answer. Judging from history, and judging, if you look at this, market cycle indicators, right? And we were actually to the highest level that we have ever been here. And typically a new market cycle will start once we have, a recession, right? And the rising unemployment rate, earnings decline, and then the central banks coming to cut the interest rate, and there's a stimulus both on physical and the monetary policy, and there was deleveraging, and then there was the releveraging, all this process, right? And we did not have any of this process, right? So if you look at this chart, using our framework, I would rather say here is that it's consistent towards the end of the market cycle, and the question is how long and that can go, and when it's going to happen. And we are talking about can be imminent or can be in the next 1 to 2 years, right? But that question is too broad. I mean, you got to have a couple of things to follow. And I want to say towards the end of last year, all the indicators pointing towards a possible pretty imminent recession. And the only thing that we're watching here is really the unemployment rate. So we're waiting for the employment basically to turn to the downside, or the unemployment to turn to the upside. And we haven't seen that yet, and we were still looking for that. And we are open-minded towards either way. So this chart is showing the unemployment rate and versus the 6 months moving average. And as you can see, every time when they climb above the 6 moving average, and the recession follows. And if you look at this, we already climb above that. And obviously, if you look at the past non-farm payroll, it appears to be pretty real. The labor market is very resilient, right? And what also makes this kind of cycle is very unusual is there is this large divergence between GDPs and the GDI, and they should be the same because it's just income and expenditure of two parts of the balance sheet, right? But you have a large divergence, and the GDI indicating recession and the GDP indicating expansion. And similarly, in the employment, non-farm payroll was pretty resilient. And if you look at a household survey and a private survey, and a private data such as ADPs, and we just show deterioration. I would say most of the states in the U.S., and by the way, they're large states, they all show the increase of unemployment rate, and typically they that's coincided with the recession. And also, I think recently the retail sale is a pretty, the retail sales and was not as strong as people were expecting. And then also there's the large kind of divergence between, small business sentiment and investor sentiment. Obviously, investor sentiments are very buoyant, and typically they are very similar, right? But if you look at the small business sentiment, and they're very depressed. And we can debate a lot of different reasons for that. And I think one of them is the inflation, right? They typically impact negatively on the people's, kind of a small business sentiment. And the investors obviously were buoyed by the asset prices. And I think, within all these puzzles, right, deciphering the economic fundamentals and just one part of the variables for the financial asset. And we also talk about the predominant kind of drivers for the financial asset is actually the liquidity, which we have talked in the past. So how do we put everything, this together? And I would say we are really kind of data driven, and we look at the cause and effect, right? So from the monetary policy perspective, we would say is pretty, it's restrictive in the sense that it's the borrowing cost is high, so that it reflected for the small business, the borrowing and the credit card, borrowing for the increasing delinquency for the average consumers. So I would say the monetary policy is pretty tight from the credit channel perspective, right? So the monetary policy they work through different channels. There is a financial condition channel, and there is a credit channel, right? So the credit channel basically allow people whether to borrow money for spend, right? So from this perspective, I would say it's very restrictive because you saw the mortgage lending is collapsing. You saw the credit card delinquency was rising, right? And you saw the small business lending was falling. You saw the lending standards was tightening, and you saw and you see the loan demand was falling, right? And the other channel is basically the financial condition. As we all see, the credit spread is record low, the stock market is all-time high. So and that is the easing financial conditions, and that impact a smaller portion of the populations where they own the financial asset. And finally, what impact the spending is unemployment, is employment, right? So as long as people have a job, they will spend. So we are following all these factors, right? I would say from the monetary policy perspective, it's restrictive. The financial conditions, right? The financial conditions are actually relatively eased because of the rising, financial, prices. So that's the mix of the picture here. And I would say physical kind of stimulus was supporting the market, and we see the physical, kind of stimulus are waning. So if you look at that, I would say, still there's more headwinds than tailwinds, right? The monetary policy work with a long and a variable lag. So the more you stay restrictive, the probability of the recession increases. However, on the other side, we do see some of our leading indicators showing that potentially there is actually a cyclical upturn right here. I just show one of the example here is the South Korea semiconductor export. If you look at here, it's very robust in the increase, and that's typically leading the ISM and which also ISM lead the economic activities. And one nuances I want to read into this is because of the semiconductor wars between U.S. and China. And I think China was stockpiling the semiconductors, and I do not know how big impact that would, have impact on this. And the other one is, is the new order to inventory ratio. We see that has been picking up Would that result in kind of a turn of ISM? We see some of ISM in the manufacturing and the servicing, they were stabilizing and they start to turn higher, although from low level. And that actually will argue for kind of a time period of a cyclical upturn. So I would say that may happen, we just need to follow the underlying data and to see how things will change. So how would I conclude this? I've talked a lot, basically almost like talking one hand and the other hand, right? And the matter of the truth um, is that was the data picture that's presented in front of us. So I would say, the bigger picture that we are at the end of the market cycle remain to be our base case, and I think it's highly unlikely. You can argue. I mean, there's no for us there is no such a thing to argue that this is a start of a new cycle. Okay, so the question is really how long this cycle can persist. And to answer that questions, we really need to look at the underlying data, and we will happy to provide the update as we can go. I would say a lot of people say, we're comparing current time period versus 1995, right? So that's kind of a soft landing scenarios. So if you look at the chart here, in 1995, the market cycle is really just starting, in market cycle indicators, right? So and we can just look at the macro environment that we have with versus at the time, the leverage ratio is a lot higher than during that time. Both for the government leverage, corporate leverage, consumer leverage, right? Unemployment rate in 1995 was a lot higher, so there is a room to come down. And our unemployment right now is at a record low. So the further expansion, looks like very stretched. You had basically the peace dividends of the Berlin Wall, fell, Chinese economy, reopen, Eastern Europe and Russia, Eastern Europe, kind of labor force become very productive, and all those things. And obviously, people compare with the productivity gain for the internet during that time versus AI, which we can have a separate discussion. But if you look at evaluations, you look at you look at the valuations, you look at our market, various market indicators, and you can see it's rather more comparable to 1998 to 1999, to 2000, right? And the question is, whether you are in 1998, 1999, 2000, and I think to answer that questions will have a dramatic impact on the on how you think how far this equity market can go, and to come back that I think you can not only just look at the economy, you also have to look at the market positioning, look at the liquidities, and obviously the economy will evolve, and we will just follow our process. And for now, we think there is a possibility of extension of the market cycle. For how long, we do not know. We have to monitor what is coming data, and then we have more informed kind of views. I think I will stop here. I'm not quite sure if I make it clear to you, Eric.
Well, that was a comprehensive overview. Thank you. So now, what kind of particular risks do you see out there that would make you change your mind to everything that you just told us? And in particular, I would like to hear your thoughts on the possibility that inflation could prove way more sticky than most of us thought at the end of last year. Jim?
Yeah. So like I mentioned, I think the risk is, I think we're pretty confident, and I think this is the dynamic of late and end of market cycle dynamics. The question is how this market can extend, right? How much this market, kind of a cycle can extend. As we know, our market is very highly financialized, right? So the financial, the higher stock prices, and actually do have feedback loop back to the economy. And on the other hand, that as I mentioned, the monetary policy was restrictive and the fiscal, kind of a policy are winning. So if you balance these things together, I would say how long this cycle can be extended is really will depend on how sustainable is the stock market. And secondly, is how the monetary policies, kind of how the monetary policy and the fiscal policy become stimulated again. From that perspective, we do not think that the Fed will proactively to ease the monetary policy. They may cut interest rate, but that is hard to see that they will cut aggressively to stimulate the economy with the maximum, employment. And also before election, we do not see a big, large fiscal stimulus coming. And if these things change, then we change. And I think the final risk is really the election risk. We have talked about this, is that in the new world that we're going to see in the very long run, our view here is we will have increasing large physical stimulus. And because debt level is so high and the interest rate cannot go too high, and once they threaten the stability, it will be monetized. So I think that's the regime that we are seeing in the very long run. However, you have to navigate through this. There's ebbs and flows of this. So, I would say here is that if Trump get elected, and I would think there will be much larger physical stimulus coming, and he certainly will ask the Fed to, keep interest rate low, to cut interest rate, and if the interest rate go higher, the way for the Fed to keep the interest rate low is to buy the bond, so AKA return of QE. So I think those are inevitable. However, if the Trump is kind of elected, and if the prospect of him being elected, I think the market may discount that sooner. So how soon, how fast, I do not know, and I do think that the election risk is a big risk, so those are the things that I think it will impact, our thinkings in terms of the timings, kind of a more shorter term, cyclical upswing and a downswing that we are facing, but probably will not derail the long-term picture of the market cycle view.
Okay, got it. So in the past, well, you always like to mention liquidity and how liquidity impacts the asset markets. So what is the current status of the liquidity situation?
Yeah.
And where do we go from there?
That's a very good question. I think, liquidity is such an overused term, right? So I do not like we talk about this. There's no magic kind of indicators and the bullet says, this is the liquidity. And we have talked about this for the financial asset. We talk about different kind of indicators, right? So one is we talk about the M2 growth relative to the real economy, to the nominal economic growth, and as a percentage of the market cap, right, to measure the impact. So that's one thing we're looking at. And then liquidity can also just create it out of thin air. We're talking about the financial asset, right? If the volatility fall, and then the investors or market participants just lever up that asset. And I think in the post-recession, world, central bank policy have a significant impact in terms of the liquidity. So we can talk about that right now. I'm showing this about Bloomberg screen with you. Henry, you can see it, right? My Bloomberg screen.
Sure, absolutely. Yeah.
Yeah, sure. So on the top here, there's a white line. This is basically the bank reserve, right? And then the blue line is the small cap, right? And then the orange line is the balance sheet, Fed balance sheet. So we know Fed, started the QT, right? In 2022, Q1 2022. So you can see the balance sheet has been declining. It has temporarily increased after the Silicon Valley Bank kind of a regional banking crisis in March 2023. But generally speaking, balance sheet has been declining. However, if you look at the blue lines, right, if you look at the white lines, right, you see actually the bank reserve, which is the bank reserve, and it actually has been increasing. And the reason for that is basically the bank reserve is the liability side of the balance sheet, right? You need to understand the other liability component, how they have been doing, in order to understand how this bank reserve will shrink or will increase. So the blue line is the small cap index. As you can see, actually there is a pretty kind of a good fit between small cap performance versus the Fed the bank reserve. So I think we look at this, we can see, oh, okay, we see the bank reserve has been increasing, even though there is a QT, the balance sheet of the Federal Reserve has been declining, which is just just looking back, right? So for us, we have to look forward. To look forward, I would say here is that based on the current forecast, right, the QT will continue, right, and that is negative for the liquidity, right? But at a certain point, the Fed also indicated that they may pause, kind of taper the QT, and that will become, the headwind that headwind will go away. So we have to monitor that. And the other thing that we have to monitor is this reverse repo facility, which is on the liability side of the Fed balance sheet, right? So if the reverse repo, as we have talked about in 2023, the reverse repo basically dropped from close to 2.25 trillion, right, all the way down to half trillion, right? And that's a significant injection of liquidity into the market. And I think in our last update, we forecasted that towards the end of March, maybe this will run to close to zero. And I think that under the current pace, we probably will come down, pretty lower level into in by March or April. And I think the other uncertainty here is that if the curve start to flatten out because the market anticipates Fed to hike, so the overnight reverse repo reverse repo rate may be higher than the term kind of the Treasury T-bills. In this case, this may go higher, and that will be the liquidity headwind. So that's something that we have to monitor. And finally, if you look at another side of the Treasury, the Fed liability account is basically the TGA. So we can see here, the Treasury have built up, close to 800 billion TGA account. Now, if Yellen decide to spend down this 800 billion, okay, the Treasury account without just spending on this TGA, that is a positive for the liquidity. So what I'm trying to say here is that there is various factors to impact the liquidity outlook. One is the QT that impact the balance sheet, and then the other is basically the Treasury general account and also reverse repo that impact the liability side of the Federal Reserve balance sheet. And finally, then we have a record in kind of a supply of a Treasury, and based on the most recent most release of the QRAs, the duration impact is was not as large as people were feared. So if you put all this together, I would say here is that once the reverse repo decline to a certain level, at a very low level, or if it is rebound from here, and if the QT continue, that is a tightening for the liquidity conditions. But there are so many moving puzzles, right here. I think we just have to monitor the situation closely. For now, I think the liquidity continue to be supportive, in the very near future. When I say very near future, we're talking about like 1 month, 2 months type of a horizon.
Okay, well, thank you. This was a great overview. So if we tie all this together, what's your near-term outlook for different asset classes?
Right. So, first of all, we talk about the interest rate, right? So I think we have shown that, this is a very long-term, kind of a 10-year, kind of interest rate chart. And we have to talk about this in a different horizon. And I would say in 2020, towards the end of 2020, we think that we have reached the secular low of the interest rate, and that we are poised for a secular kind of bear market for bond. So I think in the very long run, we are structurally bearish on bond. But from cyclical perspective, we are very bullish on bond. So I think we have to kind of separate that kind of the views. And the reason we are cyclical perspective, we're bullish on bond is that is really based on our forward-looking views of kind of how the growth and growth picture and the inflation picture. We think overall, generally speaking, we're still in the late stage of the market cycle dynamics. And I think if the Fed, just cut interest rate back to neutral, that we're talking about like 2.5% of the Fed fund rate, and then the market is priced the Fed fund rate to goes down to all the way to let's see, we can have one chart here, to 3.5%, right? So from that perspective, I think there will be a lot of more room, for the bond to rally, and not to argue, and not to mention that you are able to collect, 4.3% of the, kind of the coupons, right, without taking the equity risk, and if there's a recession, and I think this can go really well. And if you compare, we also have the, look at the risk premium of the equity market, is basically, record kind of low equity risk premium. So, and then the credit spread is very low. So you compare across all the different asset classes. I think from the risk reward perspective, from the longer term, I think the interest rate is the present a better investment opportunities. And from short term, we talk about the interest rate probably have a peak, and then we'll have a rebound, and can they go up to go up a little bit more? I think yeah, it certainly can, but I think we are rebounding to our levels where I think that increasing positions, or if you don't have positions, buy into that can be a good idea. And then the other one we talk, the other one I mentioned here is really the curve. So if we look at the interest rate curve, we are as the steepest, we are as the most inverted level for very long period of time. So we think that that this curve is poised to steepen from here. So I can see here, this is a 2 and 10s, treasury curve, and we are the most inverted basically in the past 40 years, and the only time that we were more inverted, it was during the 1970s high inflation environment, right? And we have stayed in this in this inverted area for a long period of time. So I think the risk reward favors the curve to steepen, and two scenarios that the curve can steepen, right? One is that if we have recession and the Fed cut the interest rate, and led by falling of the front rate, The other one is if inflation pick up and the Fed think that is temporary, and they refuse to increase the policy rate, and you can also see curve steepen. I would say the first scenario is probably more likely, right? And then we can talk about stocks. I would say here is that the AIs, and also the technology, kind of like a rally driven by AIs and all this. That is not a kind of a discussion that is predicated upon the economy discussion, right? That is have a lot to do with the liquidity per se, and also the market positioning. Obviously, valuation is a yardstick in the very long run, but in the short run, it does not really matter. So from that perspective, then we see that because we think the liquidity conditions can continue to be supportive in the near term, so I think the equity market can continue to be supported. At the same time, I think if you look at the market, various kind of quantitative method we're looking at, is that at the short term is actually close to the exhausting point. It's poised to go down. However, I think in the market euphoria, right? The sentiment can remain larger, and it can overthrow a lot of the quantitative indicators that we have. So what we see here is very difficult to handicap the exact path of kind of the bubble, kind of stocks, how they can perform, how they can behave, how they can go from here. What we can see here is that there is a risk of a further parabolic rise of that, and but from the typical our quantitative measures, and it's close to the exhaustion point. Now, it looks like it's very difficult to take actions on that, right? And if you think so, and we would agree, but we do see that if a cyclical pictures we were mentioning that were improving, then we will see some of the kind of cyclical sectors and even the commodity producers may pick up. And I think internationally, international stocks may kind of in the non-US stocks, particularly emerging market, can pick up. And I think later on we can talk about Chinese equity, which is a big component of the emerging market. And we were actually positive, as we mentioned at the beginning of the year. So that will take care of the kind of the stock side. And then from the currency perspective, so I have a dollar index. As we have discussed in the past, and typically US dollar will rise if in the tightening cycle, and typically they rise in anticipation of the Fed tightening, and that's the first leg of kind of a rising of the US dollar. And then once that is priced in, the US dollar will fall, and anticipating the peak of a hiking, right? And obviously we are looking at the monetary divergence between the US and the rest of the market, and we are focusing on the US leg, right? And then if there is a risk off, and then we have a final leg of US dollar rally driven by kind of risk off, and it will go high from here. So I think in the situation we are having here is that if we do have an extension of the current market, and probably that will be driven by easing financial conditions. And if there is easing financial conditions, that will argue for lower, kind of, US dollars. So the US dollar can go below, kind of this white line that I show here, 101. And if we do have risk off scenarios, right? And I think the US dollar probably will rally from here, and for at this particular moment of time, we do not have a strong views of one way or another. But we do have some views in terms of because we are constructive about the Chinese economies, And I think some of the countries whose economy is levered to Chinese economy may see their currency to appreciate. So their currency to appreciate and also the risk asset to appreciate as well. So that's kind of our take at this particular moment of time.
Okay, Jim, thanks for that. Very interesting. And a bit of a contrarian take on the markets. Now, talking about contrarian, and this is something that you just mentioned. I think that a couple of months ago, you were quite positive on Chinese equities. Now, given the recent rapid decline of the Chinese stock market, combined with the recent policy of the government, have your views changed? And also, if China embarks on massive stimulus packages or stimulus actions, would this mean that China bails out the global economy again, just like it did after the global financial crisis? What do you think?
Okay. So, about China. Yes. So talking about contrarian, I would say, if you look around the, kind of the narrative, the consensus narrative right now is one is the interest rate go higher for longer, and the other is China uninvestable, right? And I think the third one is basically the Chinese, U.S. exceptionalism driven by technology, AI. And I think these are probably the most consensus kind of views. And we are exactly opposite of that. Not because we are seeking contrarian, but rather we are following our framework. And our framework is telling us that with long and variable lead, actually the U.S. economy is poised to slow down and weaken, and with a probability of a recession. At the same time, the fiscal stimulus and the monetary the policies in China actually will start to have an impact on the Chinese growth from the very short term cyclical perspective. As you see, we focus on cause and effect, right? And the measures, on which is basically composed of a fiscal policy and a monetary policy. So China has been, kind of the interest rate is at a very low level. They were cutting the interest rate, and they were easing. I mean, the housing bubble the burst of a housing bubble is a self-inflicted wound. Which actually is a good thing they do it, because it's things will get worse if they let the bubble grow bigger, right? But if you let the bubble burst, and you manage that process, is actually is the positive things. And then I think they're trying to support the stock market, right? The financial effect for the financial asset. So I would say, from that perspective, I think from the cyclical short, kind of 6 to months kind of views, we actually think the probability is high for a strong rebound in Chinese kind of asset. Now we talk about the valuation is not a timing tool, but it does give you kind of a yardstick of what you are buying, right? So the Chinese PE ratio is 7 times, right? Chinese stocks, and the US PE ratio is 37 times. You can always think about that as a kind of a long-term call options without kind of a standard decay, right? So I think we remain constructive in Chinese stocks, and we actually think that from short term that the countries who is levered into the Chinese economic development may benefit from that.
Okay. Now, yes. So I think most investors agree with you about the valuations in China and the potential for an economically driven rebound. But there are the political risks, the political events that have caused a number of international investors to proclaim that China is uninvestable. What do you think?
Yes, I think they were so cheap. Is that's exactly the reason why the Chinese asset is so cheap, right? So everything comes with a price, and I think the Chinese asset become investable as soon as everyone agree is uninvestable, and I think it's really question how much the financial asset is discounted for various scenarios, for the economic slowdown in China and also the geopolitical situations. And I would also actually agree that there will be permanent discount of Chinese asset in terms of the multiples versus the rest of the versus the U.S. And the other DM countries probably. But the discount is large and deep enough from the margin of safety perspective. I think that's the first point. The second point here is that discount can narrow and can widen. And the question here is that you need to understand what will cause that discount to increase and widen. And we just talked about from fiscal and monetary policy, but domestic fiscal and monetary policy perspective, that is supportive for the Chinese asset from shorter term. Now, from geopolitical standpoint of view, we have to look at how that is changing. And we have talked about in the very long run the strategic the rivalry, right, between the U.S. and China is a strategic, okay, and their economy will continue to decouple, right? However, we also do not think that they will escalate into military conflict. I think they will manage this process to prevent acute negative economic consequences, right? And they will try to avoid direct military confrontation. So I think you can take that tail event pretty much out of the table. But the rivalry will continue. So I think in this case, we have to see, how the things will evolve in the near future. And what we can see here is that from we can see that the U.S. and China actually were trying to improve the relationship in the past few months, and will likely continue to do so. And I think the biggest factor of this, both sides have the desire, and I think that the biggest factor is the U.S. election. As you can see here, is the President Biden probably will want to avoid anything that can derail the election. So you can see here in even in the Middle East, right, and even Iran, even the Houthis were striking the U.S. navies, right, and Iran was behind the was the support, was behind was behind that. And the U.S. public sayings, kind of declare that they do not want to seek escalation of the conflict because they do not want the oil prices to go higher. And I think you can safely say that Biden does not want to escalate the kind of the tension with China. I think this all started with the Gavin Newsom visit to China, right? So I think that's probably is the turning point for the from short-term perspective for the U.S. and China kind of relationship to improve. And I would say it's probably safe to say before the election, the risk for the kind of escalation of the U.S. and China kind of tension is very low. So that's my kind of a geopolitical kind of a take in the very short term, right? And I think if you put all these kind of puzzles together, and I think it argue for the upside for the Chinese asset. However, we do think that in the long run, right, there is a secular kind of challenges for Chinese economy, as we have mentioned that we have been bearish on Chinese economy a long time ago. Really because of the housing bubble, aging demographics, and And the strategic kind of a containment effort from the U.S. But I think that we have to navigate this, from a cyclical kind of intermediate term, perspective. And from very long run, right? The investment implications out of the China and the U.S. relationship will have a bigger impact across all the different areas, right? One thing that we have talked about that it will basically have a kind of more regionalization and reshoring of the global supply chain, right? And that is inflationary. And at the same time, I think there will be global increase of military spending, and that is inflationary as well. And I think there will be redundant of the supply chain and also different technology ecosystem. And one ecosystem dominated by Chinese technology company, and the other ecosystem dominated by the U.S. technology firm, right? And that is also inflationary. Obviously, it will have impact kind of the market shares of whatever technology company that you're talking about in terms of the global market shares. And then the competition in the technology advancement will drive the capital expenditure, such as in the high tech sectors. That will foster innovation and it will improve the productivity. So that's actually the good thing. But on the other hand, I think one day that China probably will flood the market again with very cheap electric cars, kind of semiconductors and etc. Right? So that will exacerbate the boom and bust of the capital kind of expenditure cycle. So those are the long-term things, and not kind of tradable, for the near term, but that will present a lot of opportunities on both from the long side and the short side. And I think you cannot just categorize them as good and bad, and rather figure out what's the impact and take advantage of them.
Right. Yes. Well, that's kind of interesting. But what you talked about right now was kind of the confluence between geopolitics and geoeconomics, almost, where there is some amount of rationality on everyone's part. But there are also more localized and perhaps more volatile causes that could create crises. So I think everyone agrees that there's a risk of a sudden spike of oil prices, and a prolonged disruption of the supply chain, given what is happening in the Middle East, more specifically around the Red Sea, where the greater powers may or may not have very much control. We don't really know. And many argue that these are some of the key risk factors that may prompt inflation to rebound for some time. And as a result, the Fed will be forced to keep interest rates higher for longer, even longer. If this were to come to pass, wouldn't this be bearish for Treasury securities? And what would be the impact on other risk assets?
Yes, Eric, I just realized I did not answer your question in terms of risk, kind of the risk of high inflation, kind of what does that impose, what the risk that it impose on our views. So I will talk about that, all at the same time. So, like we talked about, we are the students of market cycle. So we follow that, and typically the inflation goes higher out of recession, right? Towards the end of the economic cycles, right, high inflation together with the tighter monetary policy result in the end of the market cycle. So that's typically kind of how things happen. And if you look at the oil price, and typically they go higher out of recession, right? And towards the end of the cycle, the oil price have a loss, kind of a rally, and that together with the Fed tightening, and actually that result in the market downturn, and then commodity price start to go down, right? So So I think that inflation, when we talk about inflation, we really need to think about what is driving the inflation. So inflation can be driven by, the supply side and demand side, right? So typically the inflation will pick up at the beginning of the, out of recession, and is driven by demand, right? And I would say the recent inflation that we have seen out of a pandemic is driven by both, right? Demand was supported and by the stimulus, right? And then supply on the side, there was a lot of constraints. So if it is from the demand side, then that is a good inflation, right? And if from the supply side, that is a bad inflation. So I think that at this point of time, it's very hard for me to see from the demand side the pickup of the demand. In other words, acceleration of demand to push up the inflation prices. Okay, and we talk about the retail sales have been coming down. We talk about in order for the demand to pick up, right? The people spending power need to increase, and typically you need more employment, right? And with a record kind of a low unemployment, it's hard to see how much the labor market can expand, right? And secondly, you need to kind of a wage growth acceleration, right? I think the wage growth is kind of a stabilizing here. And then you also need to see that that people start to borrowing because it's cheap to borrow, and actually borrowing cost is very high, right? So the only thing that is kind of support the marginal, kind of spending is really the elevated of the stock price, which typically help. But we know that the people who own the financial asset have less propensity to spend, right? So I think if you put all these puzzles together, I do not see the significant kind of the risk from the demand side to push up the inflation. Now, if we do see there could be kind of a risk of inflation from the supply side, which you rightly pointed out about, for example, the shock of the oil prices, right? Increase of the commodity prices or disrupt of the supply chain. And I think there was a lot of news about what happened in the Red Sea, and also the kind of a dry weather and the dry up of the water in Panama Canal, and all these things together that will drive up the freight rate and the commodity prices. And if that has come from the supply side of the inflation, that is a bad inflation. And here is the trouble that will cause for the consumers, because consumers, on one hand, the rising kind of interest rate is was kind of hurting their demand. At the same time, the higher oil prices and the higher inflation will force them to cut down spending. At the same time, higher inflation, sticky inflation, will result a Fed more hawkish than otherwise, right? So that you may, and that is basically will keep financial monetary conditions tighter. So what's the big picture of this? Is that you may actually increase the probability of the recession. And what's the impact for the Treasury securities? I mean, Treasury securities love recession, right? So I would say here is that the short-dated rates may remain elevated for longer, and the rates you may stay at a higher level for longer than you would be expecting, and the curve may flatten further than you would be expecting, but that the probability of the rates to fall and the recession to occur actually increase. I think that's kind of a kind of an interesting kind of dynamic that we have.
Okay, thank you. So
does that make sense to you, Eric?
Sorry?
Does that make sense to you?
It does. Thank you very much. Perhaps I should make some political observations here towards the end of this.
Oh yeah, that's right. So you may want to share some of your political observations.
Yeah. Well, the domestic American political situation could trigger down the road wider geopolitical events this year. because there's a distinct probability that the outcome of the presidential election could become, shall we say, contested. And such developments could easily consume the nation and the administration and tempt countries unfriendly to the US and the West, collective West, to take destabilizing actions when the US is on the path of self-harm. If and when the US is perceived as being weak and indecisive, it's always the case that the risk for surprises increases. That's one thing. More immediately, perhaps, there is this recent development that we commented on before in the war in Ukraine that may turn out to be significant over the next quarter or so. Because the Ukrainians, over the past few weeks, have managed to hit 2 Russian energy exporting ports, one in the Gulf of Finland and one in the Black Sea, not far from Sochi, and inflict damage on refineries inland, as well as on Russian steel production. Now, the significance of this is that if these strikes are the beginning of a trend of more actively attacking Russian trade and production, Russian exports of both crude and liquid natural gas could become more constrained than they are today. And this is not because of sanctions, it's because of physical production limitations. So we have now come to the end of the 10th episode of Total Convexity. Before I let you go, Jim, could you please share with us your highest conviction ideas, trades for the next, let's say, 1 to 6 months? Jim?
Yeah, sure. So, we have a talk about the various asset classes and the implications, right? Risk, reward, and etc. So if I have to pick one at this particular moment of time, as a trade, and I would say, curve steepener for the U.S. interest rate curve to steepen, I would say that's my high kind of conviction kind of ideas right now. And how do you do it? And then really depending how who you are and what you want to do, right? So I think if you're hedge funds, right, and a simple thing to do is just long the short dated rates and the short and longer dated rates, right? And or you can do do options on the curve cap, right? My favorite expression is really, I think that if the curve to steepen, and probably is driven by the decline of the short rates. I know everyone is agree now that it will higher for longer. I think that's probably is the time. So you can do receiver on the short dated options and short dated kind of rates, and the sell receivers on the long dated rates. So I think that's for if you are hedge funds, I think that's probably the way to do it. And if you're long-term asset allocators, I would say because our views of the risk reward for the short-term interest rate are attractive, and also I think that upon the next major risk kind of decline, probably is going to be driven by the recession. If that happens, I think interest rate will return to be a mitigator, risk mitigator again. So you can long shorter dated kind of interest rate, but that does not give you enough kind of a duration. So you can do kind of a levered, kind of version of the shorter dated interest rate through futures or through receivers or swaps. I think that's the way to do it. And if you are kind of retail and etc., and I would say just buy shorter dated kind of short term kind of a futures or shorter term tenor, and then you can opportunistically kind of short and longer dated kind of futures as to manage the risk of your long kind of exposure. So that's how kind of my view, how I think about it.
Okay, well, thank you. So yes, you can follow us by searching for Total Convexity in your favorite podcast apps or via YouTube. Please don't forget to click on the subscription button so that you will be notified automatically when a new episode is available. You can also follow us on X, where we have the handle @TotalConvexity. Or you can email us at totalconvexity@gmail.com. Finally, we're available on Substack, totalconvexity.substack.com. We promise never to spam you or to provide any sort of advertising or marketing. We only give you a
Okay, I think Henrik may have some difficulties. And so we are coming to the end of this podcast. And if you like this podcast, we would appreciate it if you can pass along to anyone who may be interested. And this concludes the episode 10 of our podcast, Total Convexity. I'll see you next time.
Disclaimer: the information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.